Well, get them while you can. 55 temporary tax provisions are set to expire at the end of this year. The full list, published by the staff of Congress's Joint Committee on Taxation, includes many benefits that you might not have heard of, such as the 3-year depreciation rule for racehorses 2 years or younger. There are also more than a half a dozen widely used tax breaks on that list. Several have lapsed before, but were reinstated retroactively, causing some taxpayers to scramble at the last minute to take advantage. And joining us right now with more on these expiring tax breaks, which of course you might be able to use, is CPA and IRS audit expert Joe Mastriano. Good morning, Joe.
Good morning. Glad to be here.
All right, so what are some of the best tax breaks for just Joe average to take advantage of if you, say, don't have a racehorse?
Most people, according to the IRS, are not average, and they're all targets for audits. So some of the provisions that are expiring, if you have your house foreclosed on, normally they would let you out of the cancellation of debt as income, but that's going to expire. So if you're having your house foreclosed on, you need to tell the lender to cancel the debt during 2003, because if they do it next year, you'll be paying taxes on the amount of that remaining mortgage that they canceled.
So
that's a big one.
So is there any chance that we could see some help in Washington in getting that reinstated for homeowners through 2014?
I don't really know. There's always last-minute things. There's always last-minute lobbyists. There's people within the IRS that try to get things changed as well. So now more than before, it's important to keep up with the latest stuff.
Right. And which tax breaks should you stay away from? If you want to avoid an audit, for example.
Well, if you want to avoid an audit, like my clients, I have a 4-part method on the return itself, which is part 4, is that you explain deductions. People need to kick back and look at the return that they're sending in and see if it makes sense. The IRS makes you guilty now and wants you to prove, the reasonableness of your whole return. It's not enough just to have receipts and canceled checks and invoices for your expenses. So, if you have people, there are people that still send returns in that show they hardly have any taxable income, but maybe they've paid $40,000 for mortgage interest, and, they have 5 kids, and you would expect them to live on more money.
So you mentioned mortgage interest. Let's talk, too, about mortgage insurance. The premium, you get a deduction, or at least you have been able to get a deduction, but that's going away, too, right?
That's exactly true. It's simply stated as that. This is the last year, 2013, to take that PMI, the premium for mortgage insurance.
Boy, and I would think if there was going to be any kind of lobbying done, that would be one item that would draw out the lobbyists, because that's huge for homeowners.
Well, not really. It depends, because what happens is, as your mortgage goes down, people should look at the mortgage insurance premium that they're paying. It's usually not that high, but if you have a multi-million-dollar home loan, you may have a high mortgage insurance premium. But what people do is, as it's being paid off, they neglect to drop the amount of insurance that's being covered.
Yeah, okay, that's a good point, too. All right, thanks for joining us. That's CPA and IRS audit expert Joe Mastriano here this morning on KFBK.